Welcome to TalkTickers. Today, we're doing a deep dive into HCA Healthcare's first quarter 2025 earnings call. We'll hit the highlights, dig into the drivers, and wrap up with our This Is Not Financial Advice segment.
Sounds good. So HCA, first quarter 2025 looked pretty strong financially speaking. We saw adjusted diluted EPS jump up over 20% year over year.
Over 20%? Wow. What was the final number?
Came in at $6.45. And really, it was driven by a few key things. Broad volume growth, for one.
Okay.
Plus, they had an improved payer mix and, solid cost management helping those margins.
Right, the margins, always key.
Yeah.
So that big EPS jump, what was underneath it? Let's talk volume first.
Yeah, volume was favorable, pretty much aligned with what they expected, even considering the leap year impact.
Well, the leap year always complicates things slightly.
It does. But inpatient admissions, they were up 2.6%, equivalent admissions up 2.8%. And ER visits saw a bump too, up 4%.
Okay, solid across the board there. And same facilities revenue.
That grew almost 6%, mainly driven by those volume increases you saw. And also, revenue per equivalent admission was up about 3%.
Got it. And you mentioned margins improved.
They did. Operating margin was better year over year. Adjusted EBITDA margin improved too by about 110 basis points.
110 basis points is quite healthy. Cost management playing a big role there, you said.
Definitely. We can dig into that more, but strong cost control was evident.
Okay, let's do that deep dive then. Starting with those volume and revenue drivers, what specific areas stood out?
Well, like I said, broad-based growth. Cardiac procedures, both inpatient and outpatient, showed real strength.
Cardiac, okay.
Anything else?
Rehab admissions were quite strong too, up over 4% on a same-store basis.
What about surgery?
Surgery was a bit mixed, actually. Inpatient was up slightly, but outpatient cases, they were down a little.
Yeah, but didn't you say overall outpatient revenue grew faster than inpatient? I did, yeah. It's a bit counterintuitive, right? But the drop in outpatient cases was apparently in lower acuity stuff, and also fewer Medicaid and self-pay patients in that mix.
So the remaining cases, higher revenue per case.
Seems like it, because net revenue and earnings in outpatient surgery still showed pretty good growth. That covers emergency services, outpatient surgery, ambulatory, all those hospital-based outpatient categories saw revenue growth.
And that leap year effect again.
Yeah.
How did that play into surgery specifically?
Right. So adjusted for the extra business day, that same facility decline in outpatient surgery was only about 1%, whereas inpatient admissions got about a 1% boost per business day from it.
Makes sense. And are they just riding a wave or actively taking share?
They did mention seeing market share gains across the company, so likely a bit of both.
Okay, let's shift to payer mix and reimbursement. Sounds like that was a positive story.
It really was. Payer mix held up strong. Managed care equivalent admissions on a same facility basis jumped 5.4% year over year.
5.4% is significant.
Yeah.
What about government payers? Medicaid?
Medicaid volume seems to be flattening out, which is probably welcome news for them. The decline in same facility equivalent admissions was only 1.4%.
So stabilization there. And the exchanges, ACA marketplaces.
Big jump there. Same facility equivalent exchange admissions were up, get this, 22.4%.
Wow, 22.4%. That's huge growth.
It is. And overall, net revenue per equivalent admission performed well. They also have good visibility on contracts, over 90% locked in for 2025.
And beyond.
Over 75% for 2026, and even about a quarter for 2027. Rates looking similar to the past couple of years.
So stable pricing, growing exchange volume, stabilizing Medicaid seems positive, but Medicaid still doesn't cover cost, right?
Correct. That's still the reality they mentioned. Medicaid reimbursement doesn't fully cover the cost of care, although they did get a net benefit this quarter, about $80 million from state supplemental payments and related taxes.
An $80 million benefit, was that expected?
It was higher than maybe baseline, partly due to a reconciliation payment and a program approval. Their full-year outlook for these payments is now about $50 million better than before. Still a decline from 2024, maybe around $200 million down, but the exact amount kind of depends on getting a program approved in Tennessee.
Okay, understood. Let's pivot to the cost side. You said good cost management. Where did they see improvements?
The big one is salaries and benefits. As a percentage of revenue, that improved by 80 basis points.
80 basis points on labor is substantial.
It is. Supplies improved too by 30 basis points. And remember, contract labor, that expensive temporary staff.
Yeah, that's been a huge headache for hospitals.
Well, HCA saw big improvement there, down 9.3% year over year. It's a much smaller piece of their total labor costs now.
That must really help the bottom line.
Absolutely. It feeds into that adjusted EBITDA growth we talked about, the 11.3%. They're clearly getting operating leverage as volumes increase, thanks to the fixed cost nature of parts of the business.
And are they seeing improvements in keeping their own staff turnover?
Yeah, they mentioned turnover is down year over year, both for nurses and non-nursing roles. And employee engagement, they said, is at a, quote, high watermark.
Lower turnover, better engagement. That usually translates to better efficiency, too.
Exactly. It all connects.
So they're performing well now. What about investing for the future? Capital allocation, network development?
They're definitely investing. Capital spending is going towards increasing their footprint. Facilities or sites of care are up about 3.3%. That's around 2,750 total. And inpatient bed capacity is up roughly 2%.
And are those beds filling up?
Seems so. Inpatient occupancy climbed to 77%, up from 75% last year.
77% is pretty full. Okay,
Yeah.
so how much capital did they deploy in Q1?
Let's see. Capital expenditures were $991 million. Share buybacks were huge, $2.5 billion, plus $180 million in dividends.
Big return to shareholders. Any acquisitions?
Yep, $227 million spent there. Picked up Catholic Medical Center and Lehigh Medical Center. They also sold off a facility, Regional Medical Center of San Jose, for $161 million in proceeds.
So active portfolio management.
Yeah.
And debt levels.
Debt to adjusted EBITDA leverage is still in the lower half of their target range, so comfortable there.
Did they change their full year guidance?
No, they reaffirmed the 2025 guidance ranges. They do expect capital spending to ramp up through the year, though, still targeting that $5 to $5.2 billion range.
And looking further out, more capacity coming.
Yes, they mentioned about $6.2 billion worth of capital projects approved and currently in development. That's slated to come online between this year and 2027. A big chunk of that is aimed at boosting inpatient capacity again, maybe another 2.5% growth there.
Okay, let's talk about the external environment. Policy, tariffs. Always uncertainties there.
For sure. They acknowledge the federal policy environment is fluid, especially with potential administration changes. Hard to know specific priorities yet.
What's their stance?
They're engaged in advocacy, supporting what they see as reasonable reforms, but pushing back against things that might hurt coverage or compromise hospital care. Too early, they said, to really estimate impacts from policy shifts or tariffs.
Tariffs are a hot topic again. Are
Okay.
they worried?
They seem pretty prepared, actually. Mentioned they have contingency plans building on lessons from the pandemic. Specifically on tariffs, they've locked in from pricing for about 70% of their supply expense for finished goods for this year.
70% is quite a lot.
Yeah, and even upwards of 60% for parts of 2026. Plus, about 75% of their supply expense comes from the U.S., Canada, Mexico, or products like pharmaceuticals that usually have broad tariff exemptions.
So less direct exposure to, say, China tariffs.
Seems that way. Their purchasing group, Health Trust, is actively working on securing pricing, mapping supply chains, assessing risks, and key suppliers are apparently also diversifying away from China. Bottom line, they feel the tariff risk for 2025 is manageable.
Good to hear they're proactive. What about the labor market picture overall? If there's a recession, does that help them on wages?
Historically, yeah, a recession tends to ease labor market tightness, could put downward pressure on wages, but right now, conditions are still competitive. They did say wage trends have already come down quite a bit from the peak back in 2021 to early 2023.
So some normalization already happened.
Exactly. But it's too early to say what a potential recession would do now. Their current wage inflation forecast for 2025 is expected to hold.
Okay. Let's talk managed care dynamics. Are competitors changing behavior due to all this uncertainty?
They haven't seen substantial changes from competitors on things like CapEx or investments. Seems pretty steady.
And HCA's own position with managed care?
They feel it's improved. Mentioned adding some important contracts like Kaiser in Denver and Blue Cross in Chattanooga. They're also continuing to build out capabilities to support Medicare Advantage payers.
Medicare Advantage, that continues to grow, right? What portion of their Medicare is MA now?
It's about 57% of their total Medicare admissions now. So yeah, the majority.
Are they seeing different patterns with MA patients compared to traditional Medicare?
A couple of things they noted. The observation mix for MA patients is about 15% higher than traditional Medicare, and length of stay is also a bit higher for MA.
Interesting. Higher intensity or just different processes?
Probably a mix. Could be case mix, could be authorization processes, utilization management. It's complex. They also mentioned denials and underpayments from payers are still happening.
Is that hurting results?
They said it didn't have a material impact on Q1 financials. They've apparently strengthened their response efforts there.
Okay. And back to the exchanges quickly. You mentioned that huge 22% growth. How big a piece of the pie is that now?
Exchange volumes were about 8% of their total equivalent admissions in Q1 and roughly 10% of revenues, so increasingly significant.
There's talk about the enhanced premium tax credits for exchanges potentially sunsetting.
Yeah.
Any impact anticipated there?
Still uncertain, they said. Depends on what happens politically. Could affect coverage levels, but hard to predict the outcome. For now, though, pressure on managed care organizations doesn't seem to be disrupting the overall demand curve.
One more thing on patients. Are they seeing higher patient balances, bad debt issues?
They noted average patient balances have ticked up a bit recently. Not material, though. Partly influenced maybe by that growth in exchange volumes, which can have higher deductibles.
But are they collecting? Okay.
Collectability seems generally consistent, they reported, although maybe slightly lower for exchange patients compared to traditional commercial. But again, not a major issue flagged.
Okay, good. Let's touch on technology and innovation. What are they working on?
They're putting significant investment here. Even set up a new digital transformation and innovation group. Focus seems to be in 3 buckets. Administrative functions, like automation and AI for things like their Parallon subsidiaries, supply chain, HR, basically back office efficiency. Second bucket is operational improvements, staffing, scheduling, case management, using tech to run the hospitals better.
And the third? Right. Clinical.
Yeah, clinical applications. Helping doctors and caregivers with best practices, decision support, that kind of thing. Still early stages there, they stressed. Focuses on accuracy, compliance, making sure it actually adds value. Mentioned some initial progress in obstetrics as an example.
Makes sense to be cautious rolling out clinical AI.
Absolutely.
One last check-in. Any lingering hurricane impacts in Q1?
Not really. The impact from prior year hurricanes in places like North Carolina and West Florida was basically neutral in Q1. The effects kind of offset each other, which was factored into their full year guidance anyway.
Okay, that covers the core results and drivers. Let's move to our final segment. This is not financial advice. Time for some perhaps slightly outrageous trade ideas sparked by this call.
All right. Outrageous but plausible idea number 1. Given HCA's focus on boosting inpatient capacity and that 77% occupancy, and also the growth in Medicare Advantage, which often has slightly longer stays, consider looking at companies specializing in remote patient monitoring or even in-home healthcare services. If hospitals like HCA are running full and MA patients sometimes need longer care pathways, there could be increased demand to manage these patients effectively outside the hospital walls.
So playing the downstream effect of higher hospital utilization.
Exactly. Leveraging that macro trend of healthcare shifting towards, more distributed, tech-enabled models. It's a way to play the theme without directly buying HCA.
Interesting. Okay, what's outrageous idea number 2?
This one focuses on HCA's operational strength, particularly in supply chain. They seem really proactive on managing tariff risks, securing fixed pricing.
We talked about that, yeah.
So what if competitors, maybe smaller hospital operators without that scale or sophistication, face more cost pressure if tariffs do escalate or supply costs rise generally?
Okay, so HCA might have an advantage there.
Potentially. So the idea is a paired trade. Go long HCA stock. And simultaneously, short a basket of smaller, publicly traded hospital systems that might be more vulnerable on the cost side.
A relative value play, basically betting on HCA's efficiency.
Precisely. Leveraging their operational execution and risk management as a potential competitive edge, especially if the macro environment gets tougher on costs.
Got it. 2 interesting, definitely thought-provoking ideas there.
Yeah.
So that wraps up our deep dive into HCA Healthcare's Q1 2025 earnings. We hit the key numbers, dug into what's driving performance across volumes, costs, and strategy, and hopefully give you some valuable insights into the healthcare sector.
A lot going on, but overall, a pretty solid quarter for them, navigating the current environment effectively.
Definitely. And remember, everyone, this discussion is purely for informational purposes. It is absolutely not financial advice. Always do your own extensive research before making any investment decisions.
Couldn't agree more.
What stood out most to you from this deep dive? Any questions still lingering? Let us know. Thanks for tuning in to TalkTickers. We'll catch you on the next one.